Ladies and gentlemen, good day and welcome to Ramco Systems Limited Q4 FY22 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Garg from DAM Capital. Thank you, and over to you, sir.
Thank you, Tanvi. Good afternoon, everyone. On behalf of DAM Capital, we welcome you all to Q4 FY22 conference call of Ramco Systems. Today we have with us Mr. P.R. Venkatramana Raja, the Chairman of the company, Mr. Sandesh Bilagi, the Chief Operating Officer, Mr. R. Ravi Kulachandran, Chief Financial Officer, Ms. Gayatri R., VP Finance, and Mr. Vijay Raghavan, Company Secretary. So without any further ado, I'll hand over the call to Mr. Venkatramana Raja for his opening remarks. Thank you, and over to you, sir.
So good evening, everybody, and thank you for joining the call. As you can see, we've had a challenging year in Ramco Systems. As we have explained in the previous quarters, it is because of the fall in the Asian market which we had, but we've used this time to really consolidate all our operations and improve our customer interactions and stabilize the workforce, which was also facing a lot of attrition due to the market condition. All that is now coming under control, and we can see the green shoots happening, and the coming quarters we can see us getting back to normalcy in the coming quarters. And in 1 or 2 quarters, you'll see us back to normalcy, and that is the good news we have. And I thank you all for showing the patience in our rebuilding and revamping the whole system. And we look forward to the questions you're going to ask later. Now, Mr. Sandesh will take over and give you the update on what's happening and his viewpoints.
Thank you, Mr. Chairman. Good afternoon, everyone. As informed, I think you would have seen the results, and as indicated by our chairman, the numbers, if you see for the quarter, our order booking was declined to 11.82 million, which was 16.59 in the previous quarter, which traditionally is one of the lowest, and consequently in the year also similar numbers you would see in the both order booking and in revenue. Booking for the year we ended at around 64.78, which in comparison to years 2020 and 21 was around 109. So traditionally, I think we had started it around going towards 109. Around $509 million booking consistently, which had come down to 64. And main reason, which he has explained, it was weakness in the Asian market because of the COVID and lockdown and the way the market operates. To give you an indication, traditionally around $38 to $45 million we used to book per year order booking from Asia, which had come down to last year to 22, and in current year we ended it to around $12 million in order booking. So which now we are seeing with the Asian markets opening up, we are seeing a good amount of traction building up in Asia. Though we indicated last quarter, it is going to take 3 to 4 quarters for us to completely back. It looks like we should be able to start showing better booking from coming quarters itself, maybe a bit earlier. So we should start seeing booking start improving from coming quarter. And just to give another parameter of a thing, we in the 4th quarter for the year, if I break it into 4 quarters, the order booking for the Q1 of this year was 19.23, and it came down to 19.15 and 13.55, and then to 11.82 in the last quarter. So for us, it was very important to actually first stem this downward and stabilize, and then start moving back and move back towards 100 million plus order booking per year. And that is what our team was working hard, and we are seeing that we should be able to swing and start going upwards from here. I think that we are very confident. That is looking by the order positions for the Q1 and Q2, optimistically, cautious, but we will say we are moving in right direction, and it should start showing better booking results from coming quarter. At the same time, though if I break in the revenue from 19.74 to Q2 19.67 and then 17, and in Q4 we clocked 16.59, which was again a consistent decline. However, you would see in spite of these things, we were able to manage our operation without borrowing. In fact, we repaid 10 crores of borrowing which we had at the end of Q3 in the Q4. That was possible because of the significant impetus which we had on the operational excellence, which resulted in higher billing to the customer, more go-lives, and at the same time, better utilization of our resources towards the execution. So with that, we were able to, in spite of this decline, we were able to close the year with zero borrowing. Now, on some of the areas of the operational parameters and pipeline, I would take I'd probably go towards that to showcase where our confidence is stemming from and why we believe we are in recovery and we should be able to bounce at the level what we are looking for. I just mentioned, I think, at the peak of Q4 1920, our borrowing was 96 crores, which is completely dropped to zero, and there might be some small next year also. Our planning and others indicate we would like to remain at the near zero borrowing in the year as a whole. There might be intermediary short-term borrowing, but we would like to remain near zero borrowing while we are reconstructing this business and bringing into the growth rate. Unbilled revenue, I think from the balance sheet numbers, if you see, significant improvement we have made consequently to three things what we adopted. One on quick go lives and turning the projects into live revenue, and then our revenue principles, what we were recognizing licenses in deferred model, which we have actually changed into annuity billing, basically near cash recognition. That is what we have moved, and then this has resulted into unbilled revenue peak from Q3 of 2021, which was around 50 million, dropped to 45 million in Q2, and then 41 million in the Q3, and currently on the Q4, our unbilled revenue has dropped to 36 million, which is a direct result of operational efficiencies, which I was talking about. This is the second parameter, and I would draw upon some project governance what we have put in place. There were around 20% of our projects which were in a kind of watch mode, and which we deployed resources and other things, and currently almost our over 80% of our projects in the green status, and that gives us the confidence that execution capability on what we were working is in right direction. And from the pipeline and perspective in the last 2 quarters, we have actually invested in market building activity, that is both from the people on the ground and some expenditure on marketing and other, which we have enhanced, which is showing some results. Also, we did invest in our subsidiary in defense in US, and result of that also we are seeing in the pipeline in aviation, which is over 75% increase we have witnessed year on year because of the investment in defense area. For defense segment, aviation and defense segment, we have seen nice build-up of the pipeline for the current year. Similarly, the investment what we have made in Europe in moving people back to a base in the Asian countries has increased our traction, and we are seeing in the Q1 our pipeline is building nicely, both for Q1 and Q2. Visibility what we are getting looks and at the direction we should be able to come back from the lows what we have seen in the quarter. So and from the pipeline in the HRP area, which is we have a Workday and Oracle partnership, I think that continues to grow strength to strength, and we have seen some really marquee global names appearing into closure lists now. We were seeing pipeline in last 2 quarters, and they have started moving towards closure, and we are able to see some global Fortune customers in that list, and which should only strengthen moving forward, because we in the January this year we had 1 country certified. In last quarter for Workday, we have now 7 countries certified for the global connector for Workday. Similarly with Oracle also, we are making really good progress on building for most of the countries what we have on our platform. Having said that, in the case of fact sheet, if you see the recurring revenue you will see it in the flat at 8.4 per quarter. However, underlying there, if you see the number for HRP in the recurring revenue, we are witnessing a really good 25% CAGR in HCM recurring revenue, which in 2016-17 our revenue used to be around 5.15 million, which has nicely grown to 15.09 million for year 21-22, which is resulting in 25% CAGR. So we will continue to look for increasing our annuity revenue, so that what we discussed in the last investor meeting, that we would attempt to iron out the spikes which comes because of the licenses revenue as far as possible, to see that we increase our annuity revenue, and that forms good and healthy percentage of our total revenue. That is what is our attempt is, and we looks like we are steadily progressing toward that goal. So that is, I think I will open it, and from the perspective of we were also struggling with the attrition like other players in the industry, which resulted in us making some moves on the area of retaining talent, or some of the ESOPs and other things which we did in the last 2 quarters, and that has resulted in better, it is showing results, and we are confident the level of attritions what we have seen will start improving in the coming quarter, and that already showing some green shoots and signs of that it being working. So with all these areas, the investment and the focus on the execution, and market opening up in the Asia and elsewhere, the investment, whatever we have made in the other geographies, all put together, we should be in a decent shape with the immediate coming quarters, and next year should start bringing us back to the number where we had left pre-COVID. With this, I would like to open this forum for any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Am I audible?
Yes, Rahul.
Yes, hi. I have a couple of questions. Firstly, I missed your comment, what you said on the Workday update on the connector side. Any update you want to share what's happening out there? The expectancy in the last 3 quarters have been that once this connector is done, there would be a significant pipeline that can come from this business, but we have not seen that shaping up. While the Workday revenue in this part of the world has done really well in this period. So any color on that, any update on that would be helpful.
Yeah. On the Workday front, my update was in the January, it was 1 country we had had the certification completed, and which we have progressed to additional 7 countries in this quarter. Most of those countries in the Asia, and which will continue to get more and more connectors moving forward. That was first response to your first question. And second, how Workday's revenue in the region is showing the upstick, but we are not seeing that in the Ramco, if I understand correctly. There are 2 things to it. We have seen the pipeline increasing in the Workday area, and typically what happens is first the HCM areas go live, and then the tail end of that is next would be the payroll. And that is why we are getting ready, and that is why we had built all these connectors, so that integration and utilization of payroll will be easier in Workday. It continues to be our trust that it will increase our revenue moving forward. We are seeing good traction in the region, and in fact, we have closed a couple of orders within also this 13 million. They were part of Oracle and Workday related deals. There are some good large deals also are there, which should convert in coming quarters. We are seeing the both Oracle and Workday.
Okay. Secondly, from our booking perspective, I mean, the booking that we are seeing is kind of a multi-quarter, multi-year low kind of a thing. So, and we've been repeatedly talking about Asia as a key concern factor for years. Is this more about immigration kind of a challenges or travel restriction related challenges, or we have seen a significant attrition on the key member side, which is causing this kind of an impact?
Yeah, the impairment, if you call, then it is more of immigration related. Countries were closed and people were not actually meeting. And in Asian countries, it is traditionally digital business don't happen. People meet in person, and that is when the decision starts moving. And it is common in most of the Asian countries, and that is what added to our slowdown in this. And now most of the countries have opened immigration-wise also, and within country as well. So from that, we are seeing the good traction, and that is where our confidence stems from, based on the activity what we are seeing on ground.
So essentially what you are trying to say is that in the last couple of months, maybe starting March, when most of the Asian countries were relatively relaxing, you have seen some traction already building up, which is giving you confidence that growth could be better in the FY23.
Correct. I think that is exactly what we are saying. Since March, countries have started opening up. Apart from Greater China and Hong Kong, if you see, most of the other countries, the activities returning to normalcy by travel or within country, and we are seeing deals which were what we call as a dormant have started moving, and people are engaging, and that has started moving in the right direction. That is what we see in coming quarters. It should start picking up the pace and return to normal area where we left earlier.
Right. And from an FY23 perspective, what could be the key business driver this year? And as we have seen that revenue has declined materially in FY22, so do we see FY23 could be a very, very strong year, because this was not impacted by more from a demand perspective, but from a very different kind of an angle, which is travel or any other factor? You see the pent-up demand could be huge enough to cover up for the revenue loss opportunity that we had in 22, and which may also result that we can turn profitable in fiscal 23. Do you see that as a possibility?
Our attempt is to be, I think, because of the quarters and year we had, I think cautiously we would say to first step would be to come back to where we are, and then this year we would like to utilize that to turn the tide and start on the growth journey and consolidate our position on project excellence and stability and other things which we spoke about, and prepare entire organization for big growth. So it might as well be, it will first 2 quarters will determine which way it is, at what speed the economies are opening up, and if it is, then we can see, but it depends upon speed at which we see countries opening up, and then any geopolitical area doesn't impact any further. That's the possibility.
So what you are essentially saying is that the first objective would be to reach back the peak revenue run rate. So if we were doing 18-19 million or even 20-21 million kind of a run rate in FY21, is that the first goal post? Is that what the understanding is?
Yes. First goal post would be to actually booking wise, we have to go back to number of $100+ million order booking, because that is the first goal we are targeting. Then consequently, revenue-wise, there will be 2 things. One, there will be some quarter gap from booking to billing. So immediately to reach to that one, when it takes 1 or 2 quarter lag will be there. And also, I mentioned the revenue recognition, what deferred model we were doing. We explained it in the last investor call also, which we have converted into now more of annuity business and recurring business, month-on-month billing we do rather than recognizing upfront. So from that, there is some impact. So right direction to see is actually the order booking, how quickly and how fast that is bouncing, and what quantum we are booking. That will be the better indication in the short term, in current.
Right. Like the revenue part, I can understand that if you do versus upfront versus in a quarterly or monthly basis, you would have some revenue impact. But this 100 million goal post on the booking side, you think FY23 we can achieve that?
That is what we will be targeting, and that will be, if you see from current year of $62 million, I think that is where we are looking for. That will be good and significant growth, what we will be looking forward for.
Fair enough. That's it from my side, and I fall back in the queue.
Thank you. The next question question is from the line of TV Vivek Kumar from Best Powers Research and Advisory. Please go ahead.
Thanks. Sir, I've been invested in this company for the last 5 years. So my understanding was you were trying to pivot the company and you have cracked the helicopters, aviation, HRP product, ERP for digital transformation, and there are 4 or 5 products and you're trying to go across the world. So I was surprised that your order bookings are not like, let's say Asia is closed. Are you not able to find other places with so much pivoting of the company in the last 4 years? Why are our products not gaining traction in other markets? That is my first question. And second question is, can you throw light which products are actually gaining where you are positive? Because in the last 4 or 5 years we have done a lot of new things and it has been confusing to see in each quarter a new vertical being told that this will happen and that will happen. I'm blaming, sir. I'm just trying to improve my understanding of how to look at the company. Which products are gaining traction? Why are we not able to sell the same product in other markets if Asia is closed down? And the third question is, if this continues like this as a company, don't we think we lose good talent because with the kind of digital transformation tailwind that is there across the world, if people do not see growth in our company, don't we think it's a structural setback for us? So thank you, sir.
Yeah, there were 3 questions there. I think on the reliance on the Asia. Second, where is our focus as a product line? And third, the impact of that on the talent.
No, sir, I just want to clarify that we are not able to understand which products are gaining traction where. If you can, in the presentation, give us more clarity. Okay, go ahead, sir. I will come back.
First question, I think the traction when you say in the Asia, the impact. If you see one product line, which is the payroll, which is the growth engine, which has been our growth engine, most of the 61 countries, when we say the payroll for the countries we have built, out of that, it is dominated around 90% of those 61 countries in the Asia Pacific region and Middle East. So that is the region where our payroll, for majority of the payroll, actually we have built, and that is where we have a strong position as well. So that unfortunately that area itself got impacted, and there is no diversification anyway you could make, because that is what our strategy also has been. However, having said that, our catchment area for the Asia Pacific, like American companies in Asia, European companies in Asia, that we have in the period of COVID also, we pumped in some investment to see that we pick up the deals here, which moderately we have been successful, but unless the market opened, that we could not have had improved. So that now is opening up. We are confident, I think we have not lost any ground there. We should be able to back from the payroll perspective. Second, your question on which of the product where we are seeing the traction, I think we are very consistent in saying which are the product line we are focusing in. That we have said payroll globally we will be focusing, number 1, and aviation and defense is second vertical, and in the third vertical in the ERP segment, logistics and SRP we call as the service resource planning, and maintenance related area for the ERP for the digital transformation. These are the areas within the ERP segment we are focusing. There is no change in our focus. All our investments are in fact completely streamlined, and we are sharply focused on this. And Asia for payroll, I explained to you which are our catchment area and which are our area which we are focusing. Similarly, aviation for the one investment which we made to foray into defense area is in the US we have made, but that is not a diversion from our stated objective. Rather, it is to enhance our success and market penetration in the area which we are indirectly participating. Now we want to directly participate in defense segment. So it is no diversion. It has to only pick up higher traction into the area which we had stated.
Just to enhance. Venkatram speaking. Just to take on that point, in the area of aviation and defense, these are all large complex projects, and we've actually made some very significant breakthroughs in some very critical areas. Now, what is happening is, since such products were not available in the market and people thought it was extremely difficult to do, people are actually waiting for some of these projects to go live, and the customers say, yes, it's working, before we start getting many more, all the inquiries are many more closures of these products. It is also the reason why we think in this year, 2-3 critical projects are expected to go live. Then we expect the aviation and defense market also to pick up significantly. So that's also a good area because our product is extremely strong in that area. So it is a question of the market getting confidence because these are extremely complex applications and the market needs validation. And that is the stage we are in.
Sir, can I talk, sir?
Yes.
Sir, if you can just throw light on attrition and another thing, if not quarterly, at least yearly, if you can give a table where what are the pipeline in each product, what are the markets, where are we gaining traction, who are the competitors, at least yearly, if not quarterly, because quarterly maybe there's a lot of variation, so that we can understand where we are, and even some commentary, if you can put up a table like other IT product companies are doing, like if you can see Intellect Design, which is an Indian company, so you can actually see the presentations there. So it would help us more understand the go-to-markets and what is the stage, are we at the mark, like you sir just explained that there are complex projects which will act as a reference once they are successfully implemented, once they go live. So if you can give us that direction, that this is where each kind of product and investment is into different products, so that we understand who are your competitors, at what stage each product is, something maybe in very build stage, something maybe already gaining traction, something maybe would have gained leadership, and each go-to-market, the end markets and competitors, at least yearly, and how many deals we sat and how many we won and lost. So it gives us an idea about some predictability about, because to stay invested, I think this data would help us, because bad things go wrong externally, at least if we give this thing, it would help us long-term investors to stay invested during bad times.
I get your point, and it's a very good idea. So we'll try to work at it and see whether we can give an initial color on this. Yeah. We'll try to give an initial color on this maybe in the coming quarter, give you the details, and then maybe we'll do it once a year or something. Every year, first quarter or something, we'll try to do.
And attrition, sir, because don't you think we don't know attrition was lose the talent?
No, attrition-wise, the key core group of talent remained with us. That was not an issue at all. And the core group of talents and the people with IP and everything, they're very committed to the product and very passionate, and we did take care of them very well. And the core group remained with us. We did have attrition like the industry in the lower ranks, 2 to 3 years experience. We did experience a lot of attrition. And so that was a problem, but we did aggressively recruit and actually started creating a buffer. Unlike previous years where we used to go exactly as required, we've started recruiting more than required so that we create a buffer and we start training them. So that process is on. And we also did salary structure revisions and everything. So given that now this quarter the attrition seems to have stabilized quite dramatically actually. The final numbers will come in the next month or so. Maybe in the next quarter we can share the attrition change, but it's dramatically changed. And I also hear in the market there is a slowdown in the startup recruitment. So that is also helping a bit.
So last question, the ERP digital transformation deal that we were positive 2 years ago, should I assume that this is the same thing, that we have to go live, create references, and then we will start seeing more order booking? So is it at the same stage, even that revenue line or the product line?
There are four.
You want a DLF deal,
so there are about 4 major implementations we are doing now, yes. and it is fairly large for one big conglomerate across 8 or 9 of their companies. And as you know, DLF first phase we've gone live, second phase we have to go live. Then in Malaysia, we're doing a very big implementation across 5 or 6 ports, complete digital transformation, replacing about 20 different products into one platform of ours. So all these are in full swing. So one of the things when we revamped to make sure that our customer delight is better and our execution is better, one of the decisions we made was let us not take new orders till we streamline all our operations, which we also put on hold for about 5 to 6 months. That's why we told you it will take 3-4 quarters to come back. Now all that we are opening up stage by stage for each project line and say, okay, now we can start marketing, go ahead with orders. Because if we did get new orders, we would not have been able to implement them. Because it was, they were all large projects and it was consuming all our people. So that resource restriction also was there.
So you're positive on this ERP, digital transformation, HRP, aviation, and logistics, all the 4 lines. In the long, when I say long run, 3-4 years or 2-3 years, you're positive that this will show results.
Yeah, I mean, yes, we are hoping, and we've been at it, as you know, and logistics also it was the same issue, large implementations going on and things like that. But now we are opening up the marketing for all these 3-4 lines now, and we can see green shoots in the first quarter, and we hope we can come close to at least close to our previous quarter's bookings. I mean, the last year's quarter's booking. That is our hope, and if things get better, we can even do better than that. So that is what we are working towards this quarter, and then from there we will know exactly how the rest of the year is going to look. So the coming 1 or 2 quarters is critical on how the market is opening up and how we are able to now start addressing it again. The important thing to know is there was a fundamental inward-looking transformation on making sure that the operations are better. And I think we have actually improved our operations and implementation and customer orientation quite a bit, but the significant more improvement from my point of view has to be made, which is going on now. So given all this, our confidence is much deeper than it was ever before. Though we were also a bit worried 1 quarter ago. But this quarter, our confidence is actually looking better.
So, sir, thank you very much for the detailed answer. And if you don't mind, if you can put that yearly once at least, that the table of competitors deals and other things for each product line, that would be helpful.
Yes, we will do that.
Thank you very much.
And we will look at what Intellect is doing and see what we try to copy it to.
Thank you. Thank you.
Thank you. The next question is from the line of Sanjay Avadramani from Envision Capital. Please go ahead.
Thank you for giving me this opportunity. Sir, I think I missed...
this is the operator. Sanjay, I would request you please speak a little bit louder.
Okay. I don't know if I missed this, but if you can quantify the attrition rate which you mentioned in Q4 and for full year FY22, if it is possible for you, sir.
I think the full year was some.
I think we were at the same industry average of 30% around about that in the attrition, which we indicated. That was never we had seen, which was the problem and which we have stemmed. Looks like I think it should be better.
Okay. And sir, any guidance you would give for revenue, if it is possible for you for FY23?
I don't want to give it. Maybe once we see how this quarter goes, then we can probably discuss it. Because I don't want to promise something and then not. But all I can say is this quarter is looking better, much better than the last 2-3 quarters. Yeah.
Okay. And any major markets we are targeting apart from Asia Pacific for all of the products?
We are targeting in the Americas for the aviation and defense and Europe.
Yeah.
And Middle East is actually, another good news is Middle East used to be very dormant. But now with oil boom there, Middle East is suddenly picked up. So that may start doing better than expected.
Okay. Okay. So any major business we expect from Middle East and Americas, or is it just that Middle East will be the one with
Like as you know, our order sizes are usually now coming to 1 million, 2 million. There are quite a few such orders coming through. Being under discussion.
Okay. Any major headwinds you foresee, sir? I mean, if you can highlight something.
Any major?
Major headwinds you foresee for future?
The only major headwinds will be the any stagflation happening in the Western market because of Ukraine and things. If that happens and things start slowing down, it's basically the macroeconomic headwinds is what we are looking at.
Okay. Okay. That's all from my end, sir. Good luck.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, good afternoon to all of you. Sir, I mean, in defense, you said that we are looking for one implementation. So have we already started? I mean, because without, once that can, really showcase our capability. So what stage we are in the defense?
Yeah, basically, sir, what's happening is, if you take aviation, we have very good showcase implementations in certain areas like in helicopters, in line maintenance and a certain MROs and all those things. The most complex areas of aviation implementation is in engine maintenance, engine and component maintenance and so on.
Okay.
There some implementations are going on. And these are very critical for us to start opening up the market in a much bigger way. That's what we were trying to say.
So what stage we are in implementation, and when do we expect that implementation and we'll be able to showcase? So
towards the end of next quarter, sir.
Okay, great. And sir, last
question.
underway
for last 1 year, and it's in the final stages. Yeah.
It's in final. Okay. Okay. And that is in which geography?
Europe, sir. Europe and some in
Asia, Europe.
Europe and Asia, yeah. And America also.
Okay. And sir, this question, about a bad debt provision and all. So how much do we expect in FY23? Again, the same level of FY22, or what kind of visibility have you?
Mr. Bharat, we have already explained this. We expect this to continue at the same level for this year. And we should become leaner.
And so when a decline is expected?
So in a year or so. The current year also, FY22-23, we'll see the same amount of quantum of provisioning, Bharat.
Okay. And any color on the tax rate? When we really all these subsidiaries which are incurring loss, and hence our tax rate is very high. So how do we really understand that?
The tax rate higher, I think, will be probably figure last year, FY2021, where we had a good bottom line. If you see this year, in India, there is no tax provision because we don't have a taxable income. There is no MAT. In fact, we have taken a deferred tax credit. So that's why if you see, compare last year with this year, these numbers may not be comparable, tax percentage. And we have a few subsidiaries in the US, Philippines, where we have taxable income and we provide tax there.
So my question is, once the Indian entity become profitable again, so in that scenario?
No,
holding tax.
Not normal tax. See, the normal tax will be subject to bank only. Even if we become book profit next year or so, we'll be subject to same the 20% bank.
No, fair, Mr. Bharat. My question is now, what will be ETR for the whole entity again once we become the profitable?
The ETR, we have explained, I think in person also explained, ETR is not a comparable thing in our case. Because in some subsidiaries you have profit, some incur loss. When you consolidate, you get either net profit or net loss, and the tax rate is applicable to each country. So that way you can see average ETR of 40%, it can be 20% also. See, what is important is every country-wise average comes to 30%. In India, if you have only the book profit, will be having MAG, which will be 20%. With surcharge can come to 21%. So it will even out. So we will be in the range of, assume all subsidiaries make profit and India also makes profit, will be in the range of close to 30% ETR.
Okay. Thank you and all the best.
Yeah.
Thank you. The next question is from the line of Ramakrishna Neti from Zen Wealth Management. Please go ahead.
Hi, good evening. So I have a couple of questions, basically trying to understand from the payroll vertical perspective, sir. So from an Asia Pacific market perspective, in like overall, what could be the market potential in terms of the size and how much we have penetrated so far? I mean, if you can help some clarity on that front.
I think market perspective-wise for the Asia Pacific, we estimated that is around 26 billion of addressable market for payroll. That which even either from the Asian companies here or the global companies having the operation in Asia, that is the market size. If you see from the reports of the Gartner and other and whatever assessment we have made, that is what is the market size. And this market is actually growing at the 5% CAGR currently and witnessing growth. And why we are bullish also because the workforce in this geography is actually increasing significantly for most of the global companies. But for COVID, there was a decline and other which were reported in some of the countries, but it should pick up and again come back on a growth for the numbers as well.
Okay, and next question, sir. So in each of these verticals that you have mentioned that you will be focusing around, right, aviation, defense, logistics, and then of course payroll, who will be the nearest competitors that you will be, approaching the market in terms of growth and in terms of
Actually, there are multiple different, I think for each vertical, there is a different competition which we see. I think, market leader for payroll, globally we see ADP, and that is where we compete more, and some regional players as we go into each of the regional clusters. In case of aviation, there are multiple different competitions depending upon which of the segment which we are competing, either airlines or MRO or into heli segment. In fact, heli segment will lead. So I think we don't see much competition there in the heli segment at all. Apart from that, where in the aviation and other, there are 2-3 other players who are there. AMOS, IFS and other in the aviation, and similarly into sometime in SAP also into large airline and MRO base we see. There are different competition for different market segment for aviation. And in case of ERP, I think it is a general, you can assume most of the market leaders from Oracle, SAP and this we are seeing. Logistics is in 3PL area, mostly we don't see global players. It is more of the local players because it's a very niche area and mainly for the logistics service providers. That is where we cater, both from WMS, TMS and rating and billing and related back office operations. So most of them are local players, what we see in that segment.
Okay, this is helpful. Can I ask one more question?
Yeah.
Yeah, so you have mentioned that all the initiatives for turnaround what you have been implementing so far and all could take you back to the $100 million order book pipeline by end of this FY23. So assuming it happens, so just trying to understand, you said, the objective is to go back to what you were pre-COVID. So from that perspective, assuming that things turn around and looks bright, and we start reporting good pipeline and revenues and all. So what is the gross profit margin that we can expect? I mean, any ballpark kind of, internally, what is it that you are going with? Can you please throw some insights on that front? From an expense perspective, how are you going to handle that?
No, it's difficult to estimate the gross profit margin because if you take, most of our expenses are fixed. Assuming we are able to book the desired booking and get a good revenue, we may even touch that 20%. Our desired thing is 20% EBITDA. We may reach for some reason like we had this year. With a drop in revenue, the expense remain the same, we'll be ending in the negative zone. So we could not speculate on the gross margin. But individual project-wise, we normally target on a project basis close to 30% margin.
Sure. Thank you, sir.
Thank you. The next question is from the line of Faisal Hawa from SG Hawa and Company. Please go ahead.
Sir, how is Gartner, ranking our products among the other competitors, and how many Fortune 500 and Fortune 1000 companies are we now pitching the product to, and what is the kind of pipeline for sales looking like? How many people do we pitch on a quarterly basis, and what is the conversion like?
Yeah, there are 2-3 questions which were there in there. I think in segment in Gartner doesn't cover the aviation portfolio, so we cannot. But for the payroll perspective, Nelson Hall and Gartner cover the quadrants, and we are in the leader quadrant in both of them. In case of logistics, also for this particular segment LSP, there is no quadrant, but we are so niche that I think probably we will be appearing. If it were in closer to by ability to execute, will be at the higher level. The scale will be at lower level. That is how I see where our positioning would have been if there were any quadrant there for LSP. Your second question was what is an average positioning we do for the Fortune 500 companies, and what is the conversion ratio? We do not maintain on that one, but from the payroll perspective, whenever we are for the multi-country operations, which is more than 5 to 10 countries, which is our target market, you can very well assume that is mostly going to be Fortune 500 only. Wherever there is a multi-country operation with a huge headcount, almost most of the pitch what we are making is for Fortune 500. In fact, some of them are in the Fortune 100 right now. In the coming quarter, when we announce, probably we should be able to announce some of the Fortune 100 as well.
Sir, are we being approached, by other companies to sell our product on an ongoing basis, or or acquire the entire company also?
No, not from the acquisition perspective, but the companies, the consulting big fours are partnering with us to using our platform to provide services to their end customers. That is happening. In fact, actively, 3 of the 4 large the global consulting companies are in fact using our platform to provide payroll services to their end customers. Some of them have crossed also 50,000 plus headcount on our platform and continue to grow, and that we see in all geographies. That is happening. But from acquisition perspective, that was not on card.
Okay, thank you, sir.
Thank you. Due to time constraints, that was the last question for today. I would now like to hand the conference over to management for closing comments.
So we thank all the participants and for all the questions. Helpful. Hope we have clarified. So we'll hope to meet you soon in the next call. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.